Well, good afternoon, everyone. Thanks for being here. We're very excited to continue to learn about the trucking industry through the past studies and now through this compensation study. Most of the topics I'll talk about today won't be new to you, but we do hope to share some new information about how different strategies have worked or not, and as that it relates to employee expectations and results. So our goal is that you'll walk away from this session with some ideas to consider in your own company based on your own demographics and desired culture. Our topics for this session will really stretch across the gamut from compensation strategy, ways that we can communicate that so our employees see beyond the weekly paycheck, employee financial health. The reality is our employees are not financially healthy, generally speaking, and there's a cost to this. So what is that cost, and how can we help turn that around to have a positive impact on retention and productivity? Insured benefits, we'll talk about some of the traditional types, what trends we're seeing, and some other ideas for helping employees there. And then retirement plans, we'll actually see some surprising results here. The idea that employees won't participate or don't value this benefit is not coming true in the actual results that we're seeing. Workplace financial wellness is a new, fairly new burgeoning industry that you'll hear about, because if employees are not financially well and it impacts us, them, our businesses, then is there an opportunity to really help them with that? And then finally, we'll talk about how do we define success in the end. Once we've developed a strategy, how do we know that it's working? So as we look at compensation, we know that managing it is part of the overall management of a strong corporate culture. What we know is you can't win on pay alone, and you can't win without it. And what we frequently hear from our trucking company customers is that we have an employee that is going down the street to another company because the pay rate is higher, and there's not an appreciation or understanding of all the other things that you're doing for them or the cost of that. So while rate of pay is the obvious part of the strategy, providing a career path or a vision of why someone should stay with your company over the long term, while providing a good culture and corporate values that support a bright future has really proven to be equally important. So the key is to really balance all four. We know that compensation is a means of rewarding people for their work, retaining them, attracting new ones. It's probably the most tangible expression you have to demonstrate how much you value your employees. Therefore, it's really important to be intentional and strategic, and we think to communicate the strategy of each person's compensation to them. So we recommend having a compensation strategy in writing that you share with each employee, and that the current total compensation as well as future opportunities are shared with them at performance review meetings. So what would the process look like? First of all, of course, establish objectives. Budget is always a big piece of this, budgeting for cash compensation and then determining what percentage over and above that you're going to budget for the other benefits. Benchmarking, of course, and hopefully the compensation study is going to help you there. We hope to conduct this, as Kim mentioned, every few years and refine those questions as we go. Defining the actual pay range targets, which we'll dive into in a little bit more detail in a future slide, and identifying variable benefits, which really what we mean by that is the incentive pay, driver bonuses, that sort of thing. Identify which pools of employees will actually qualify for that variable benefit and which will not. Involving associates. This is something that's often overlooked, and I'll touch again on this in a few minutes. And then most importantly, review it regularly, because things change, new opportunities come into the market. We saw the health law change drastically and change all of our options and choices. Employee demographics change. We know our drivers are aging and will be replaced with a younger workforce at some point. So if your workforce begins to shift from older employees to a younger group over time, you'll find differences in the generations and in terms of the expectations and pay expectations. And so finally, communication. One of the keys here will be to communicate to an employee the value to them, and also the value of being with your company. So here are some key questions to answer as you look at the compensation study later today or tomorrow. how do you plan to pay overall as a company versus the market? Do you want to be in the 50th percentile, the 75th? For unique positions, which may have different compensation structures, such as drivers, how will that be maintained? And apart from an overall pay strategy, how will you compensate individual performance? And we often talk about the drivers and the safety bonuses and other things that take place, but what about the office team? Giving them some incentive for contributing to the success of the company. And then what is the philosophy for insured and non-insured benefits? On the budget, it's really important to focus on the cost of benefits. We know that health insurance is rising at an ever-increasing rate. The retirement perks, all of it needs to be communicated to those employees. And of course, when you look at the targets, we want to be sure we're not comparing just to our direct competitors or who we think are our direct competitors, because you may be competing, you may be a small company competing with a large one or vice versa. And then certainly look at other industries. We certainly saw recently with the oil and gas boom that many of our drivers were being recruited away from a completely different industry. So that target percentile really determines competitiveness. And what number are you going to use over and above that for benefits? What we see exclusive of FICA and FUTA and SUTA, the tax element, we generally see companies budgeting about 20% over and above cash compensation for all those other benefits. And it's something that employees don't recognize the value of often. They're not seeing the numbers. So we think it's important to give your employees feedback and involve them in the process. And we really mean two things by involving them in the process. First, involving your core leaders and leaders at various levels. That gives you an opportunity as you're developing strategy to present the ideas and allow for feedback. Doesn't mean that you're going to take every recommendation that you get, but you'll certainly likely get a perspective that may be different than yours as an owner. You also get the chance to run those ideas by a group of people that already care about the company and they want your strategy to be successful. And so it's helpful to have that initial session with that group. And then secondly, be sure that the employee sees a future for themselves with your company. You may have the best of intentions for them, but they have to see it, envision it, believe it. And the second part may seem challenging, especially when you don't have layers of management for people to move into, but they can still grow within their own job. You may have different levels for one position. You may only have one dispatching position, but that dispatcher, as he or she gains knowledge and gets better and better at their job, may become a senior dispatcher. And that carries with it a different set of expectations and a different set of compensation. In our company, our client service associates have different levels within their own position. They start out, as a client service coordinator, which has expectations for certain things. And then as we see their performance grow, their education continue, the fact that they're impacting our customers, they're impacting other employees, then they'll move into a client service specialist role that has a different set of expectations and a different set pay and possible incentives. And then finally, that same person can move into a senior client service specialist, which everyone in the firm recognizes as someone that has really made it to the top in terms of taking care of customers. Not all employees want that kind of future. They like what they're doing and they just want to do that job that they come in and do every day, and that's okay too. But at least you're creating a vision for how they can have a future if they stay with your company. If you do performance reviews, and we see that 75% of the companies are doing that, show them how that strategy works for them and be clear on the expectations that they have in order to get that future compensation or that future title or career path. Here's why that discussion is important. Because in the absence of proactive communication, employees may assume the worst. And we saw this play out recently in a study that was conducted during the implementation of ACA, the Affordable Care Act. In this survey, 50% of the employees surveyed assumed that employers were going to drop their coverage. But in reality, 77% of employers said they were going to keep it. So in the absence of any kind of ongoing communication, sometimes employees may assume the worst because of all the chatter that might be going on outside of your company. This is an example of a total compensation statement. On the left-hand side, you can see we've used a driver in this case, Bob Worker, $75,000 pay. Imagine how powerful it would be to sit down with Bob at the end of the year and say, your pay was $75,000, but really you made over $90,000 all in. And this is a graphic illustration. This came directly from our payroll system, and if you're not a payroll customer of ours, you can buy software that does this type of thing. So finally, you want to dust it off, review it periodically. Does it still make sense? Remember, again, we talked about the oil and gas boom, and we had to make adjustments at that point. So we recommend looking at it at least annually to be sure that it still fits and makes sense. Speaking of employee financial health, or maybe lack of good health, what we know is this: more and more employees are stressed over current issues. At the same time, they're not preparing for their future financial needs. Average credit card debt is over $15,000. And we know what some of those interest rates are in credit cards. People have student loans on themselves and their kids. Some have not only one mortgage, but it was really easy to get a second mortgage to buy that big something, boat or whatever it might be. And what about aging partners, parents, those that either need care or money or both? So as far as the future, we spend our lives working, making a living, trying to support the quality of our life every day. And the challenge is to be at the same time saving for the future when we either can't work or don't want to work full time. Generally, people are behind. Estimates show that we should be saving between 12 and 15% of our pay every year from the time we're age 25. How many people do you think are actually doing that? And if you look at what the shortfalls will be, they're estimating that we'll be short, each family will be short over $300,000 in retirement that they need to live on. All in all, it's projected $136 trillion gap. Train is coming at us in just a few short years. And so you think about why that's happening. Certainly people are living longer, and it's kind of funny to look back at the 1935 when Social Security was established. Two things about Social Security. At that time, average life expectancy was age 61. Wasn't it brilliant that they set the retirement age to receive benefits at age 65? And you look at life expectancy today. For men, it's 84.3 years. For women, 86.6. Social Security, are you kidding me? It was written into the original law that it's intended to prevent the elderly from becoming indigent. That's what it says in the law. It was never designed to be a retirement plan, but we've become accustomed to hearing that I'll collect Social Security. So in reality, it funds about 25 to 35% of somebody's retirement income today, and less than that if you're a high income earner. Not to mention that fewer people are paying in for all those baby boomers that are coming out, so the retirement age is getting longer and longer, and the benefits are likely to go down even further unless taxes are raised. So gone are the days of the corporate pension funds when the company promised to pay a percentage of your pay in retirement. Some of our parents had that, some of the World War II generation. Finally, the out-of-pocket cost in retirement for a couple age 65, this is out-of-pocket medical expenses after Medicare, after any insurance coverage, it's expected to be $270,000 in that period of time from age 65 to the end of life expectancy. Crazy, right? And don't forget long-term care costs. We're living longer, but we often need help to do certain things, either at home or in assisted living or even in a nursing home. And Medicare pays almost nothing for any of those situations. So what are the effects? More stats. A recent survey, a financial wellness survey that was done nationally, 52% of the employees said they were stressed about finances. 48% of them said it increased in the last 12 months, and half of those stress said it interfered with their job. So the estimates are that more than 3 hours a week are spent at work dealing with those financial stresses, 150 hours a year. They take as much as 5 days off for sick leave to deal with those financial stresses. That's a week, a year out of the company that these stresses lead to. So obviously, it leads to a lot of other problems. And the bottom line, there's a huge cost to the employee and to the company and its customers. So is there any good news here? Employers can help. And interestingly, recent surveys show that 2/3 of the people who are participating in a 401k plan say they're doing it because their employer encouraged them to. They wouldn't have done it without their employer. 86% surveyed said that they would participate in a financial education program if it was offered. So when it was offered, what we saw is actually 63% did, not the 86 that said they would, but 63% is a pretty good number as well. And so how can we help them? By providing those workplace benefits to ease some of that burden. So we'll start with everyone's favorite topic, right? Healthcare. Where is that headed? Well, now that's another discussion, but it's anybody's guess at this point. What we know is that efforts to modify ACA so far have failed, Affordable Care Act. It's a massive law, and there's been no consensus on an overall fix. So what's happening right now is that there's actually some work underway to try and fix certain provisions of that law that both sides can agree on. The Democrats and Republicans are actually talking to one another. Can you imagine how interesting that might be? But bottom line, we're going to see the results of the Affordable Care Act for a long time to come. And reality is most people do want health insurance, and the reality still is that employer-sponsored coverage is still the most cost-effective way to get it, and usually the most comprehensive type of plans that you can access. The individual plans in the marketplace don't compare to what can be offered in the employer-sponsored market. So while our friends in Washington are working hard to fix things for us, back to the statistics that Kim mentioned earlier, the majority of the companies are providing various types of benefits. But as we think about the plan design for health insurance today, our friends are trying to fix it, but absolutely nothing is happening to curb healthcare costs. All we're talking about is health insurance. And health insurance is expensive because healthcare costs are expensive, and as you saw earlier, we're living longer and needing more expensive care for longer than we ever anticipated. So insurance at its basic design is supposed to cover the big, bad, ugly, catastrophic expenses, right? Like car insurance. Car insurance is for the wreck. It's not there to pay for your oil change or your flat tire, but we are paying high premiums for health insurance, so by golly, we want it to pay for everything. Well, it can, and if it does, it's very expensive, and it becomes actually unaffordable. So if we step back and think about using insurance like a financial tool, protect against the big risk, and budget for the small expenses, the day-to-day things that we all have, why not look at the high deductible health plan, health savings account concept? The plans are designed to give you an insurance plan with a lower premium without some of those first dollar coverages like co-pays at the doctor's office. Reality is a lot of those co-pays are now 60, 70, 80 bucks. It's not much more to just pay the doctor directly with the discount that you're already getting for the insurance. So if you think about paying the insurance company less in premiums and taking the difference that I would have paid for that copay plan, putting it in my bank account, tax-free savings account that grows from year to year if I don't use it, and I have high annual maximums that I can actually contribute into that plan. That's one thing that Washington's working on right now. They're talking about doubling the amount that you can put into your HSA, which is would be a great thing. And that money rolls from year to year all the way into retirement, helping to pay for those $270,000 of out-of-pocket expenses when I really need the money in my retirement. So it's not for everyone, it doesn't work in every situation, but it's great to have that as one of the choices in your plan or in your overall benefit program, especially if you have younger employees that aren't big users of healthcare. You can help them right now with this type of plan for the future when they will need to use that coverage. So we saw from the study that other than medical insurance, there are a number of other supplemental options, often on a voluntary basis. So the employees get the benefit of buying it at work at lower cost, and the employer isn't paying anything for it, just making it available to them. Interestingly, disability coverage is the most overlooked coverage offered. Most people don't think about what would happen if they were sick or hurt and couldn't work. But what we find is the most recent stats from 2016 show that 63% of the homes that were foreclosed on in 2016 were due to a primary breadwinner not being able to work. They lost their home because they couldn't go back to work and they didn't have disability coverage. The thought is it might be expensive. So if we look at what you're paying for medical coverage for employees, I did a comparison for a 50-employee company. The total monthly premium for all of their employees plus the owners to buy disability income coverage was the equivalent of 2 months of premium, medical premium, for one employee. That's how inexpensive it is, and it can have a major, major impact. So something to consider. Moving to retirement plans. There are a lot of options to choose from. We'll focus on 401k since that's the most popular. But what we know is that in the compensation, the pay is for today, and the retirement plan is for future pay. This is the #1 opportunity to help your employees with their gap. You can see from the stats that not all companies have plans. About 60% have some sort of retirement plan. So what are the reasons cited for not having it? You'll see here. So let's address those. Hard to maintain. Bring in an outsource partner who will act as a co-fiduciary. Their job is to bring a system and make it easy. They're not expensive. It's expensive. Well, I'll show you some numbers in a minute that I think will be quite surprising. When it's designed properly, it can be very, very beneficial, not only to your employees, but also to the owners. But also, in addition to those direct costs, think about the indirect cost of not having a plan for those employees that are going to stay with you longer and possibly even create additional claims on your health plan because they're not able to retire. They don't have the money to retire. Poor participation, you'll see some surprising information on that as well in just a minute. And then, of course, liability. Don't need one more regulation to keep up with. And that, again, goes back to hiring a co-fiduciary. And what I mean by co-fiduciary, fiduciary is a person that is acting in the best interest of you and your employees. And they're doing that without conflict of interest, full disclosure of fees, and they're signing a contract that says they will accept liability for doing the right thing for your employees. So look for that kind of advisor, somebody that's certified by CFEX, the Center for Fiduciary Excellence. It's a stamp of approval on best practices, ethics, and the fees that they're charging. So looking at the plan design for the companies that do offer 401k plans, how are they designing them? 82% have match, which translates to 60% of the companies have a plan, 82% of them have match. So 42% of all trucking companies then have some kind of match. Auto enrollment is being used in only 20% of those plans. And Safe Harbor, which I'll describe in a little bit more detail, is only offered 30% of the time. Auto-enroll statistics across the nation prove that almost 90% of employees that are automatically enrolled will stay in. If that's the case, why are only 20% of trucking companies using the feature? What we heard is, well, I'm not their mother. It's going to increase my cost. If I have more participation, there's going to be an increased matching contribution. That may be true, but I'll show you the effect of designing it properly. Employees would complain. Surprisingly, there's always one, right? There's always one. But when you auto-enroll an employee, they can still get out. You're not forcing them. They can say, no, don't do that, fine. 90% of them won't. And we've actually had employees go to employers, We have auto enroll in our company. We're in the financial industry. And I had to put auto enroll. Now we have 100% participation, but my employees have come back and said, you know, I kept meaning to do that, thank you. And so it really does work. And the statistics show it. These are studies that have been done nationally. Companies before auto enroll, only 50% of them, 51%, had employees participating at 75% or greater. After it, 80%. With new employees, it takes the enrollment from 42% of them signing up to 91% of them signing up. So it really helps narrow the wealth gap and generate those savings. And these are the numbers I was referring to earlier. When someone can't retire because they don't have the money, they're in their mid-60s, late 60s, chances are there'll be an increasing cost to the health plan. So I'd like to show you, this is an actual trucking company in Texas. And I want to show you a well-designed plan and what it really does cost. So in this case, we had approximately 20 owner-operator drivers, 30 employee drivers, 20 non-driver employees, 2 family member owners, and then we had 2 younger family member employees. So we'll start with a basic 401k. This is fairly common design, a 3% cap, match 50% of the first 6, or 3% is the most that you would contribute. Put 1 year eligibility on that so that if you have turnover in that first year, they're not going to receive any company money. But you could let them participate. They could save if they wanted to, but they're just not going to get your money unless they stick with you. Limits the owners and HCE's deferrals. HCE is a highly compensated employee. It's defined by IRS as a certain income level. What happens in a traditional plan is there's a test that takes place that checks whether the owners are benefiting more than the employees. And what it does is it says if the employees aren't participating at a certain level, then owner, you're capped at a certain level. And so we're going to assume a 60% participation rate, which is the national average without auto enroll. So on the right-hand side at the very top are my owners, and my 4 owners are able to defer about $35,000 out of their pay. But my 4 owners are also getting $21,000 out of their company without paying taxes. So they get to set aside $56,000 that IRS doesn't get to tax. My company contributions to employees is about $39,000. I get a tax credit. IRS likes us to establish plans, so we throw in a tax credit. That contribution, matching contribution, is tax deductible to my company, so I have some tax savings there. And my owner's personal tax savings were $17,000 in that year. So reality, after tax, that plan cost $10,000 for my employees, which is less than $200 per year per employee. It's a heck of a lot less than what you're paying for the health plan. So what happens if you add auto enroll? Same deal, 3% cap, 1 year to get the match. I'm still going to have some limitations, but now I've got 90% of my folks participating. So top section, still the same. Bottom section, yep, it's going to cost me more, but I've helped a lot more employees. Okay, can I get better than that and help me too as the owner? Yep. I'm still only spending about $450 per year per employee. Pretty good investment, but I can make it better than that. I can do an auto-enroll safe harbor, and the safe harbor provision basically dictates the match that I'm going to give that year, and it makes that discrimination testing go away. So now me as the owner, I get to do the full limits plus any catch-up contributions if I'm 50 or older. So I'm still going to make them wait a year for my match, and I'm going to get to save more, and my employees are going to get to save more. Now look at the numbers. I doubled what I could tax defer for myself and my family. $100,000 I was able to set aside out of tax. And I actually spent a little bit less in this scenario than with straight auto enroll because I got more tax savings. So if I compare all 3 of them on this next slide, I spend $10,000 to get $56,000 in my tax-free bucket, or I can spend $24,000 to get $56,000 in my bucket, or I can spend 22 and get 108 in my bucket. So back to, it can be a really terrific tool. It just takes some planning and some design work. Executive benefits, regardless of the design, you may have some folks that you want to retain, and they may be part of your succession plan, either leadership succession or even ownership succession. So how do you help them over and above the benefits offered to everyone else? And at the same time have an extra hook to keep them on board to help you grow and manage your companies. We'll enter non-qualified plans. We won't have time to go into detail on these today, but suffice it to say that you can pick and choose who you reward with these benefits, and you can tie the compensation or retirement benefit to their performance and the longevity with the firm, or even a combination of both. So you can place vesting requirements on these. If they don't stay with you for a certain time, they don't get it. Not like the match that might go with that employee. Finally, workplace financial wellness. This is the tool that is helping with that financial stress. Term you'll be hearing a lot more about. From the compensation study, only about 17% of the companies are actually providing this type of benefit. And that's understandable given that it's a relatively new growing area, but the stats are very positive, and much of what can be addressed through a workplace wellness program is helping them understand the value of the benefits that you're providing already. So remember our stats from the earlier presentation that people will participate if you offer it. So what does that look like? Basically, it has, you can pick and choose and design this around the needs of your company, your employees, but typically it's a workshop. It can be after work, before work, during lunch, whatever it might be, but hosted at your company so you can get the employees together. There's an online financial tool that they can use very easily to do an assessment of how am I doing, me, on my own financial picture and what it will look like at retirement. And then there's some financial coaching on the phone. Once they get that result, what do we do about it and how do we work towards goals to make that situation better? Very inexpensive, between $100 and $600 per employee per year, depending on the size and design. And we recommend that you get a multi-year contract if you're going to do this, because it takes time and you want your employees to have the full effect. Allow it to be customized for each employer. So finally, just thinking through your compensation strategy. Organizations are only as successful as the people who work with them. And that strategy for onboarding, for setting mutual expectations, managing performance and culture, recognizing and rewarding people's work is essentially going to determine the type of people that will come and that will stay. So it's a balancing act between a lot of different things, from the compensation, career path, culture, corporate values, and communication. I know Dan will talk a little bit about compliance issues later, and he can certainly attest to the fact that good performance reviews, performance documentation, and regular communication can really help your bottom line. So the bottom line, employer-sponsored efforts over time can really lead to increased health for your employees, which is good for them and it's good for you. So with that, I appreciate your time today. Be pleased to visit with any of you or my partners, David or Kim. David lives in HR world every day, and we look forward to the rest of the conference and visiting with you later. Thank you.